Great. Thank you so much, Eric. So this actually set of potential papers is on the economic impacts of COVID-19 on small and medium enterprises in Latin America. And I wanted to start with some acknowledgments because this is as you'll see, a large project with a lot of moving parts and a lot of people involved, some on various of the outputs of the project. So the main PIs on all of the work are Paul Gertler, myself, Ana Maria Montoya, and Raimundo Undurraga in Chile, and then Eric at the IDB. We also have a postdoc working with us, Michael Cerda, additional collaborators on some of the outputs from the IDB, Pati Yañez, Irania Raiz, and Maria Paula. And then we have project manager, research assistants, one of whom Piero is here. And of course, we wanted to thank the funders of this project, which are the Lab for Inclusive FinTech, the Inter-American Development Bank, IDB Invest, JPAL, and We4Lac. So the motivation for this project is that the COVID-19 crisis had a large impact on small and medium enterprises. And early on in the pandemic, Paul and I were chatting and we realized that transactions level banking data from firm bank accounts, which is a type of data that we had used in projects in the past, provide high frequency measures of various outcomes for the firm. So we were seeing some quick research during COVID start to come out, but it was mostly using either survey data or other types of data that you weren't getting this high frequency snapshots of at least proxy measures of the firm's balance sheet. So we can measure firm revenues through point of sale terminal transactions, electronic deposits, cash deposits at the bank, et cetera. We can separate out between in-store and online transactions. We can look at employment and we can look at employment and banking data through direct deposit payments to employees if they use that, if they use direct deposit to pay their employees. And then we can also look at survival because we can see if the account ceases to be used. So what we did was partner with large banks and financial institutions in 6 countries in Latin America to obtain these data. And those 6 countries are Brazil, Chile, Colombia, Mexico, Paraguay, and Peru. So here you can see that across pretty much all of these countries, there was a big reduction in revenues when COVID hit. So here's mid-March 2020, and you can see that revenues fell in some countries on average to about 50% of revenues prior to COVID. So these are all normalized to the February 2020 revenues, that's 100%. And you can see the recovery as well, that it took some time, but in about 9 months, then you saw revenues return back to their pre-pandemic levels. Now, in this talk, we've looked at a number of things about what's going on descriptively with these revenues. One interesting thing that we saw in the data was a shift from in-person transactions to online transactions. And so in 4 of those 6 countries, we're able to separate those 2 types of transactions. And here you can see that in-store sales, so here I'm restricting to in-store card transactions, you can see that those had a larger dip than we saw in the previous graph, so falling even maybe down below 25% of their pre-pandemic levels, and a slower recovery during the pandemic. Whereas if we look at online sales, you can see that in some cases, like Mexico, which is the blue line, you hardly even see a dip at all in online sales, and then they start increasing right away. And you see this kind of persistent effect. So online sales are about 50% above their pre-pandemic levels in Mexico and in some of the other countries as well. In others, you do see somewhat of a dip. We've looked also, this is mostly on the extensive margin, firms that completely shut down for a little while and then reopened. But once they reopen, you see much more quickly they surpass their pre-pandemic levels than they did when we were looking at the in-store sales numbers. Then finally, so I've shown you now, those were levels for in-store transactions and online transactions. Then now I'm showing you their share of transactions that are made online. These are still all normalized so that 100% is the pre-pandemic level. But then you can see that this shot up during the crisis. So the combination of those last 2 graphs I've shown you is that the fraction of sales being made online shot way up. And in all of these countries except Colombia, you see this very persistent effect where somewhere between 25% and 50% increase in the fraction of sales that are made online rather than in person. So the next steps for this piece of the research agenda on the shift to online sales during COVID, we know that SMEs benefit from financial technologies through higher sales and profits. And we also know that temporary shocks can lead to persistent changes in the use of fintech. So once the firms make this fixed cost and this fixed investment to adopt fintech, then they don't just revert back to not using it after the shock is over. They continue using it over time. And so what we're going to do is exploit variation in the ability to shift to online transactions during the pandemic. Everything I showed you so far is just descriptive, what's going on in the data, but we have some plausibly exogenous variation from various instruments in the firm's ability to shift to online transactions, and that's what we're going to use going forward. So that's the first piece of the research agenda. The second piece is on the economic impact of government-backed loans on SMEs during the COVID-19 crisis. And here, I'm going to show you evidence from Chile. We conducted RCTs in two of the countries in which we're working, which were Chile and Colombia. So the motivation for this part of the research agenda is that during COVID-19, many SMEs faced significant negative demand shocks. We just saw that in the descriptive graphs I showed you, and they needed credit in order to maintain payroll, pay rent, and survive as a business. But most banks did not lend to the most impacted SMEs that might benefit the most from credit. And that was because of the high risk of default due to the crisis. So the banks that we talked to said, well, we're really trying to lend to the SMEs with the highest probability of repayment. But the problem during the crisis is the banks were restricting the overall supply of credit, and the SMEs with the highest probability of repayment were the ones that didn't really need a loan. They were doing just fine. So of course, if you give them a loan, they're going to repay it. But from a social planner's perspective, you would want to lend to the SMEs that are going to benefit from the most, which might be the ones that, because of the shock, because of the pandemic, wouldn't survive if you don't give them a loan, but would survive if you do give them a loan. But from the bank's perspective, that's very risky because they're probably going to misclassify some of those, lend to ones that shut down and don't survive either way, and then default on the loans. And so in response to this, governments around the world implemented government guaranteed loan programs, which reduced the risk faced by banks by partially or fully guaranteeing loans to SMEs. So often they would do something like say 90% of the loan is guaranteed. So if the firm defaults, we're covering 90% of that cost to the bank, but and they imposed requirements that the banks had to lend to these riskier firms to use those government guarantees on the loans. And so this project, we're working with a bank in Chile. The Chilean government in particular expanded their government guaranteed SME loan program, which is called FOGAPE, in June 2020. FOGAPE is a program that's existed for a long time. It started in 1980. And but in normal times, in the absence of a pandemic, on average, they disperse about $1 billion of funds. In non-crisis years. During the pandemic, they dispersed $14 billion in just a one-year period from April 2020 to March 2021. So they hugely expanded the program in response to the crisis. So we partnered with the Chilean bank BCI to offer loans to high-risk clients who had previously applied for loans but been rejected. And then due to limited funds, they could not offer loans to all the newly eligible firms. So this riskier set of firms who had been rejected previously before expanding the criteria of who would be eligible. And so we were able to randomize loan officers to half of about 10,000 SMEs. And those loan offers and disbursements of the loan were made on a rolling basis between February and July 2021. Here you can see some basic stats where the take-up rate of these loan offers so these were firms who had applied previously for a loan. They weren't necessarily still interested in a loan. 27% of them were, and they took up the loan. In the control group, the bank would still lend to the control group if they came to the bank separately anyway and applied for one of these loans, but they weren't directly contacted by the bank. That was our treatment, was to directly contact them. And so you see 2% take up in the control group, 25% difference in take up between treatment and control. Here's the distribution over time of the number of loans that went out as part of our experiment. As I said, you can see it's February to July, mostly March to June of 2021. And we're balanced on a number of characteristics, as you'd expect with this large sample size in our experiment. So that's true for a bunch of firm characteristics, as well as the categories, the sectors in which the firms are. So what were the effects of these government-backed loans on treated firms' liquidity? Here I'm going to show you on the left-hand side the intent to treat effects, and on the right-hand side, treatment on the treated. So the intent to treat is an average for everyone, regardless of whether they accepted the loan or not. We see an increase in total liquidity of in the treatment group of about 10%. But as we know, it was actually only 25% of the firms in the treated group taking up the loans. When you do the treatment on the treated, it's about a 40% increase in their total liquidity, which is saying their total the total amount of outstanding debt they have in the financial sector across all banks, which is data that we get from the financial regulator reported to the bank who partnered with us for the RCT. If you look over time, you also see similarly this increase in liquidity. And we actually just hot off the press got some new months of data, and it stays and actually increases even a little bit in the more recent months. We have now up to January 2022. And so what are the next steps on this? We have other outcomes we still need to look at. This is all very fresh results, very much a work in progress. There are other outcomes we need to look at in the banking data. So that's deposits, which are a proxy of sales, cash versus in-store card versus online sales. And we saw that in the descriptive data, but now we want to see how these loans also may have affected that. Maybe the firms could have used the loans to adopt financial technology, help them shift to online transactions, survival of the firms. And then we're also bringing in two other sources of data. So the data that our RA Piero is working with very diligently right now is linked employer-employee data that we were able to merge with our RCT sample. And so there we can see employment for formally registered workers in the firms. We can see the total wage bill of each firm, and we can also see the salary of each worker at that firm. And because the loans were specifically designed to help the firms survive and maintain their payroll without having to fire employees, we think this is one of the areas that we may have had impacts. And then finally, we got funding as well to conduct surveys, which we hope to launch soon, where we'll be able to measure some things that we're not able to measure super well in the administrative banking or linked employer-employee data. That includes the employment and wage bill, because we can measure those in the employer-employee data, but we know from some other research that even formally registered firms have a number of off-the-books employees, so we can get at that through the survey. We can also get more detailed measures of revenues than our proxy from the banking data, and then finally we can measure profits, which is something we can't really measure well in the administrative data. Thank you.
Thank you very much, Sean. An applause for him. What an interesting paper. So now I will open the floor for questions, comments, suggestions.
So Sean, you showed some of those graphs where you had sort of a comparative between different countries. How did sales change? There were a few where it seemed like some of the countries were outliers. I think you called out Colombia in particular, like online sales. Like, was there anything in the data that gave you indications of maybe what's driving that? Or is it just one of those things where if you have a handful of countries, you're going to get an outlier because of your sample?
So we definitely want to explore that more. I don't have a direct answer for you yet. One of the things about having data from 6 countries is that even though you saw the slide with the large team we're working with, it's still very hard to, every time we see something like that, we want to have someone spend, full time for a while figuring out what's going on. But we just, that takes a while because of the massive amount of data involved in the project.
Probably I can complement that with MasterCard data, because we also have some access to MasterCard data, and we see an increase on online transactions, but very dramatically. If you compare Latin America and the Caribbean with other regions, it's much more higher in terms of the online transactions if you compare with the brick and mortar transactions. So I think the COVID-19 pandemic, I think, had an effect in terms of digitalization. So, and we need to try to find ways to be organic in terms of digitalizing after the pandemic. Probably one question is regarding when you have crisis, banks sit on liquidity. And probably this is happening also here. What is your take on that?
Yeah, I mean, I think that was part of the motivation for all these government guaranteed loan programs that we saw in a number of countries, was that otherwise the banks were, reasonably from the bank's perspective, restricting the supply of credit because of all the uncertainty, because of the risk involved. We know banks are often risk averse in these decisions that they take. And so I think that was one of the main motivations here, was to actually get the banks to not sit on all their liquidity and to go out and lend to some of these firms despite the risky environment that they were in.
And what about the things for future crises in terms of the guarantee? Because the guarantee in the case of Chile is 90% of the loan. Should be 100%?
So I don't think our RCT can directly speak to whether it should be 100%. I think if it were 100%, then you'd start to worry, and this is probably what the policymakers who made it 90% also worried about. You start to worry about things like adverse selection, where the bank can then not worry about who they lend to at all. The government still wants them to be somewhat discerning about not lending to firms who are going to go bankrupt regardless of whether they get the loan or not. And so I think that's the motivation that you saw them not go to 100%. We do hope that we don't have an RCT that tests different percents to really try to answer like what's the optimal percent. We do think that this context is relevant for other crises and other government backed loan programs. Part of what we want to do with the surveys as well is really understand, what did the firms do with this money? Are they, maybe retail firms are using it to buy more inventory. Maybe, of course, in these data, maybe we see that they use it to maintain payroll and maintain workers on staff, even if that doesn't affect, even if there's a zero effect on, say, sales or profits, that could still have an overall kind of societal benefit, welfare benefit for the employees, even if it doesn't have an effect on their sales. So I think we'll be able to speak to that in something that we hope is externally valid for other crises in which government-backed loan programs are a common policy tool, but we can't speak directly on like what the optimal level of guarantee would be.
Perfect. We have another question over there.
I was wondering if I could ask a question about your first paper. So you mentioned that you will use the variation in the shift towards online sales as a sort of the effect of fintech. So I was wondering, you must have controlled for other things. There's just so much going on just before and after COVID. So I was wondering if you could talk about like some of those.
Yeah, so in the results I showed you so far are just purely descriptive, where we're not controlling for other things. What we're doing as the next steps is actually trying to get at causal effects of the adoption of these financial technologies, such as offering e-commerce, on the effects of that on the survival of the firm, on their sales and things like that. And so there we're very much worried about the things you're mentioning. Everything's changing during COVID, but there are a number of things that happened before COVID that affect the ability of the firm to shift to online transactions. So there are things like, what's the overall rate in your area of adoption of, say, card payments, if that affects whether the firm adopts technology to accept card payments, or what's the overall rate of people who have used online transactions. Of course, those are somewhat endogenous too, but we have some other instruments that we're going to be able to use there. The idea is to isolate variation that's exogenous to the firm in terms of whether they, say, sell online or not prior to the pandemic. And then the hypothesis is that the ones who are already set up to sell online will have an easier job kind of shifting to online sales during the pandemic and surviving and maintaining payroll and all of that, relative to the firms that, for plausibly exogenous reasons, did not adopt e-commerce or online sales prior to the pandemic.